Someone just paid $3.3 million for the right to profit if gold hits $20,000 per ounce by December 2026. Gold is currently trading below $5,000. And in the silver market, large positions have appeared at $900 to $1,000 strike prices, while silver trades near $70. A 1,300% bet in under 12 months. This is verified COMEX options data. Today, we break down what it means, who is behind it, and what, if anything, you should do about it. A call option gives the buyer the right to purchase an asset at a specific strike price before a set expiry date. You pay a premium upfront. If the price never reaches the strike, you lose the premium. If it does, your profit can be enormous. The gold position involves approximately 11,000 December 2026 COMEX call spreads, long at $15,000, short at $20,000. Total cost, $3.3 million. Maximum payout if gold reaches $20,000, $5.5 billion. A potential 1,667 times return. Gold hit all-time highs near $5,600 in January 2026 and is up over 21% year-to-date, significantly outperforming equities. But $20,000 requires a fourfold increase in under a year. That would need a severe dollar devaluation, a monetary regime change, or a systemic geopolitical shock. The silver positioning is even more extreme. Call options at $900 to $1,000 strikes for December 2026, while silver trades near $70. Open interest is concentrated 10 to 15 times above spot. Silver already reached $121 in early 2026, before crashing 31% in a single day on January 31st. The largest single-day precious metals decline in 4 decades. China added silver export restrictions in January 2026, tightening an already stressed physical supply chain. The most likely answer is institutional tail risk hedging, not insider knowledge. If you genuinely believed gold was going to $20,000, you would not announce it by placing 11,000 visible contracts on a regulated exchange with full CFTC reporting. A real insider would distribute across multiple accounts and strike prices to avoid detection. The visibility of this trade argues against insider knowledge. For a fund managing $500 million, $3.3 million is 0.66% of the portfolio. That is an insurance premium against a black swan, a dollar collapse, a monetary regime change, a mass global flight to hard assets. Not a conviction bet. A defined risk policy against a scenario they hope never happens, but are paid to prepare for. Do not read extreme options positioning as a price forecast. Fundamentals drive gold and silver. Real interest rates, dollar strength, central bank buying, physical supply constraints. A single trade does not change those, but the context is real. Gold up 21% year-to-date. Silver hitting all-time highs before a historic crash. Central banks buying gold at record rates. China restricting silver exports. Physical supply chains under stress. These are structural conditions, not noise. The fact that institutional capital is allocating even a small amount to extreme upside scenarios tells you something important, or these are professional risk managers who smell something coming. Something significant enough that they are willing to pay for insurance against it. And if the world's most sophisticated money is quietly buying insurance against a systemic shock, having your own insurance in the form of physical gold and silver is not a bad idea. Not as a speculation, as a hedge. The same logic that drives a $3.3 million options position scales down perfectly to a few ounces of physical metal in a safe. You are not predicting catastrophe. You are simply acknowledging that the people who manage billions are not ignoring the possibility of one. Manage your risk. Understand the macro. But do not dismiss what the smart money is quietly doing, even when it involves strike prices that sound completely insane. At Trading Mind HQ, we take what is happening at the institutional level and make it understandable for every trader and investor. Subscribe for weekly coverage. No hype, no noise. See you in the next one.